Okay, so you know that you want to buy a home, but all of your down payment is in your current home that you live in, and you don't want to list that house because you're afraid that if you list it, it goes under contract quick, then you might be homeless or not find the next home. Well, this loan program can likely eliminate all of that stress, and it doesn't cost an arm and a leg. So, how does the program work? Well, what we do as your lender is we will look at your current home and get an estimate of what your net proceeds are going to be, and then how much of those net proceeds do you want to use for the down payment on your next home. You don't have to use all of it as a down payment. You can certainly use some of it and pay off debt or just put it back in your bank account, but we're going to get an idea of how much of a down payment that you will end up having on that new home. And then we're going to pre-qualify you based on that type of loan. So we're going to say, let's just say it's $50,000. We'll be able to figure out what your max purchase price can be based on that amount, and you'll have all of your numbers up front. And that's the price point that you're going to shop in. That's the monthly payment that you can expect for the permanent mortgage or for as long as you're going to be in that home. But if you don't want to sell that house, how we write a temporary mortgage for you is you'll still shop in that same price point, but you can go ahead and make offers on the home for as little as 5% down, and we can write the offer as a non-contingent offer because we are supplying the financing for you on this home for a temporary time period until you eventually sell the one that you're in now. So let's say you find a house at 123 Main Street, it's listed for 500,000, you want to write an offer on it, and you haven't listed your house yet. It's ready to list, you've got the pictures, but you don't want to list it yet because you know it's going to fly off the market. So you went out and you went shopping first, you found your dream home, let's just say it's 600,000. So you would be expected to bring 5% because that's the minimum down. You can get that as a gift from family members. You can pull it from a 401k. Maybe you've got it in your checking or savings account. You can use that because we know that we're going to replenish the 401k account or your savings account when your house sells. So you put 5% down. We write the mortgage for you. We go to closing. You close on that house and then you sell your existing home. And when you list your house, you sell this house, and then now you've got the rest of the proceeds. We will rewrite the mortgage that we just did for you, that temporary mortgage. We'll rewrite it as if you had the entire proceeds that you wanted to use for the new home. So you have essentially two sets of closings. It doesn't mean that you have two closing costs. The additional cost for this program is roughly a title policy, which might be anywhere between $2,500 to $3,000. And we just call that the convenience tax. It's a little bit more convenient than stressing, having to move with in-laws, having to move into temporary pods and short-term, residential living. So you do have to pay for two title policies, but you don't have to pay for two appraisals and, processing and underwriting and all of that stuff. So what usually tends to happen though is we pre-qualify you for this loan program so you can go out and write a non-contingent offer. And by the way, your realtor writes the offer based on the final loan terms. So if on the final loan you actually would have 20% down, that's the offer you're presenting because that's the final loan. So you're going to be offering 600,000, 20% down, a non-contingent offer, looks really attractive to the seller accepts your offer, and then your realtor goes live with your listing on the MLS. And 9 times out of 10, when it goes live, you get a contract, and we end up converting this to a normal loan, and we don't even need the two closing options because we write a normal loan where you've sold first and then bought, and it's just like any other loan that you've ever done. But what this program allows you to do is to write that non-contingent offer, and if for any reason the financing fell through on the buyer who's buying your home, we could still legally close and be within your contract terms. So it truly is a program that allows you to buy first, then sell. Know that 9 out of 10 times you likely won't even utilize it, but it allows your offer to get accepted. And the closing costs are typically around an extra $2,500 to $3,000, which we call the convenience tax. So if you think this loan program might help eliminate stress for you and your family, and you want to explore it in more detail, I'd love to chat through it with you. Give us a call and we can go over it in more detail and give you true live numbers and scenarios.